Josh, I'll start with you because you've got four things in front of me that I want to document here. A new buy is where I want to start, and that's Starbucks, which is pretty interesting to me. Why'd you buy it?
Well, fundamentally, we can all agree it's a great company. Everyone is aware by now. They've hired the literal best CEO in the quick service restaurant space, Brian Niccol, previously creator of shareholder value extraordinaire at Chipotle. So the question really becomes like, what's the best entry in the stock if you didn't catch the bottom? And from my perspective, I thought the technical setup here looked really good. So I entered the trade. And look, I don't know that this will necessarily be short term. I'm certainly going to give it a little bit of leash. But it is a technical breakout for the stock. And I want to try to respect the technicals while I'm in it. So ultimately, there will be a stop loss. Hopefully, I'm trailing the stock as it heads higher. But I think above 103, 104 on decent volume would be like the real breakaway. And I want to be in the name for that.
I mean, there's definitely been a nickel lift, right? I mean, you could see it in the chart when we backed it out a little bit further than the intraday. The excitement that was in the market when, you know, he got that job, it's pretty clear on the screen. The question is, Brian Belsky, as you bought more as well, how sustainable you think that is and how big his lift is going to be?
We did. We bought it in April in our value portfolio. We love to buy broken growth stories. And as Josh said, they did the baller move by going to get Brian. I believe that this is a story that you're going to see massive restructuring, massive change in operating performance, and that will ultimately drive earnings growth and profitability going forward. We love the name, especially in a value type portfolio right here still.
He's charged really with shaking it up.
Judge?
Yeah, Josh, go ahead.
I want to add to that how great of a setup this is for both traders and investors. This is the worst performing stock in the consumer discretionary S&P 500 sector over the last year. It's only up 2%, but literally the worst. So, you know, even though there's excitement over the new CEO, a lot of institutional investors have been giving up on this name over the last year. But now, technically, it's 3% above its 50-day. It's 15% above its 200-day. And it's only 2% below its 52-week highs. The stock is not yet overbought. RSI is 56. I would need to see this thing at 70, 75 to conclude that all of the juice from this restructuring is already priced in. And it's just not. This year, Starbucks earnings are negative 5%. Everybody gets that. Next year, the expectations are for 19% earnings per share growth. If we get anything even close to that, this is not going to be a $95 stock.
You know, the other thing that you did, which I guess jumped out to me, is trimming Alphabet. You want to take our viewers why you decided to make that trade?
Yeah, so I've done well in Alphabet. I've been in it for a really long time, and the stock's had a big recovery. But it's had trouble. If you remember, I first trimmed the stock in July or late June. I looked like an idiot immediately. I sold it like 160 something. It ran right up to 190 when they reported earnings. Pull up a chart though. Give me like a 1-year chart. Look at how fast that rally faded. They couldn't wait to sell it. Technically, the stock does not look great. Doesn't look like the end of the world, and I'm keeping about half my longer-term position here. But this is my second trim of the name this year, and technically, it looks like it wants to break down. I don't like situations where a deterioration in the technicals are occurring at the same time that there seems to be a problem with the fundamentals. The problem here is not that they're going to fail with AI. I think they'll do fine. The problem here is that they have more competition in AI than they've ever had in their core business, and it's unclear how they'll be able to hit that same level of profitability with that competition in AI as opposed to what they've been able to historically do with search. I gave this company the benefit of the doubt for a long time. Price action is telling me there's just more doubt out there than there is enthusiasm. I did not like the way it gave up that entire post-earnings pop. So for me, I just want to be smaller there, and there are other setups that I like better.
The salient point here, Jim, as you own the stock too, is that Alphabet's core business is under assault, my words, like never before. If you look at what generative AI has the potential to do to search market share for a company like Alphabet, that's exactly what Josh is speaking of.
Yeah. Look, I think it's a great point. And the question for all investors, I'm in the stock just like Josh, I'm not trimming it, is whether these competitive pressures are in the stock price already. I think they are, roughly 19 times forward earnings. And there's a lot more, and Josh knows this, there's a lot more.
It always trades, though. It's not like the stock was at a much, much higher valuation and it's come down to 19 on those kinds of issues. I don't know, what's its historical average?
I don't have it at my fingertips, but I'm going to answer your question
22.
this way.
Yeah,
thank you, Josh.
That's part of my point.
Right. So let me take your point and work with it this way. A 20% return from here, if the earnings stay constant, would put the stock multiple at 23 times. I actually don't think, when you look at the growth rate for Google, I don't think that's too much of a lift at all. The competitive pressures are real. We know that. But by no means, and Josh, you're saying this as well, by no means is Google going to be left by the roadside there. You also have a lot of other shots on goals here. I mean, YouTube has been really a standout. You've got the web services going on. Who knows what's going to happen with Waymo? I'm really quite comfortable owning the stock here. I do want to make one point, another way of looking at what Josh is saying in the chart, and Josh knows more about technicals than I do. We all know that. But from a fundamental point of view, there's been a few quarters here where Google has seemed to disappoint, okay? There's been fundamental issues, whether it's transaction costs or things like, hey, when Bard kind of messed up on a few things, or the image generator went badly. The last quarter was good. Unequivocally, it was good. Josh makes a good point. It sold off. It didn't hold the pop. My point is this. As a fundamental investor, many times I've seen this. When you have some quarters that have seemed to disappoint and then you get one good quarter, it's not enough. You need to have a second and a third quarter. You can point to Cisco, by the way. Different stock, different industry, well, sort of different industry, but you can point to that where Cisco, for many quarters in a row, disappointed. The first time it had a good quarter, it fizzled. Second time, same thing. Now it's had 3 in a row, and the stock is roaring. What I'm saying here is if you get another good quarter in a row from Google, I think it's going to hold those gains and take off. I'm quite comfortable holding it here.
Let me give you a counterfactual.
Go ahead quick.
If you get a disappointing quarter, this stock couldn't rally on good news.
Yeah.
What's your risk management here? I got a rising 200-day at about 164 and change. I mean, that seems to me, on a weekly basis, as a good place to start thinking about a stop.
Yeah, I'm not gonna quibble. I think you've made your decision. I've made mine. My point is, at this multiple, and also knowing the market cap and knowing that as passive flows come into this market, they're going to go at least in part to Google. I'm just comfortable with it. I'm not taking shots at what you're doing, but I'm comfortable with my fundamental position.